From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Monday, October 9th. Here are the top market stories we're following for you at this hour. Israel at war with Hamas. Israel mobilizes 300,000 reservists as the death toll tops 1,100. We get the latest on potential Iran involvement, Saudi's reaction, and politics in D.C. And the market impact. The Israel-Hamas war injects uncertainty and volatility throughout markets. We're going to try to figure out how investors should react. And energy at the epicenter. Oil and gas rally. Israel tells Chevron to shut its natural gas production at a Tamar platform, which produces as much as 8.5 million cubic meters a day of natural gas. From New York, I'm Alix Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, this is always a tough day for business networks like us. You have a human tragedy event, and then you have to figure out how to manage that if you're in this market. And that's a very difficult line to understand this early in a conflict.
You just don't know what happens next. We're now into the world of uncertainty, which is incredibly hard to price. You can deal with risk, uncertainty, really hard to deal with. So you get the classic reaction we get today. The US bond markets are closed, but you buy bonds, you buy the dollar, you buy oil. This is the safety trade. This is the classic play, and you sell anything that's risky. So you sell stocks. So I don't think we really learn anything today that is particularly useful. What comes next, I think, is going to be determined ultimately by how the Israelis react, what happens next, and whether or not this remains symmetrical or becomes asymmetrical. So I think that's really hard to judge. But today, I don't think really teaches us anything useful, Alix. What comes next, very hard to determine. But you have to plug that into the context of where we are. We've just had a war. We have an ongoing war with Russia and Ukraine. We have a series of supply-side disruptions, which we've already been dealing with. Inflation is difficult to deal with. So all of that needs to be put into the equation. Yeah, and just in terms of equity markets, to your point, I mean, the Dow's erased any of the losses now. It's pretty much flat. And there is a knee-jerk reaction, right? You're going to buy defense stocks. You're going to sell airline stocks. Like that kind of dynamic. Yep. But how long those trends really play out as we hit earnings season is a very different conversation. And how uncertainty and volatility now will be addressed on earnings calls will be quite significant. Absolutely. And I think all of this is unknown at this point. We don't know what. It would be interesting to know whether or not the earnings calls change as a result of this. I doubt it. In some ways, this is an extrapolation of some of the trends we've already seen, i.e. increasing uncertainty. These are difficult factors to plug in at this point and get a clear and easily quantifiable answer. I just don't know kind of where we go from here. And that's the problem. This is uncertainty. Markets are terrible at dealing with uncertainty. So our question of the day is a fairly straightforward one. How should investors react? Joining us now, Bloomberg's Liz McCormick and Edward Harrison. Liz, what do you think? How should investors react? How will investors react?
Well, I think, like you laid out, what we're seeing already, Guy, in the markets, and we do have bond futures open today, and they're up, but they're also, the price is down from the high of the day. Like stock futures were lower, now stocks are open, and they're, off the lows of the day. The dollar's come off the highs of the day. So that flight to quality is abating a bit. And I think that makes sense because it is the normal reaction to this tragic unrest that we have over the weekend starting in Israel. And that's what investors do, go to safety. But we have this big macro trends going on that investors are really more concerned about. That is the Fed done tightening or not? We had that blockbuster payrolls number on Friday. What do we get on consumer prices on Thursday? There is just so much risk. So I think everyone, maybe when the actual cash market opens tomorrow, Treasuries yields may be down a little, but I think there's going to be very slow to reverse this trend of higher yields. Yeah, but then it feeds through into inflation expectations. If you take a look at the oil market and then how that affects sentiment, and then it gets really murky. Edward, what do you think? How should investors be taking this?
Yeah, Liz says a lot that I can agree with, and I'm trying to think about things that I wouldn't agree. I'll point out one of the things that she didn't talk about was the dollar, and the dollar's a safe haven bid. One of the things that Liz was talking about in terms of yields higher, especially at the long end, it actually is beneficial to the dollar. So either you have the safe haven bid here or you have the higher for longer and therefore a higher dollar. I think the one key component is a higher dollar in both of those scenarios. And I think that's negative probably for earnings of S&P 500 companies. What I'm looking at in particular is what are the banks going to say, not JP Morgan and the like, because JP Morgan's going to start the bank earnings on Friday, but the regionals, the KBW index is down like 24% versus the S&P 500, which is up on the year. And we've just gotten a slew of cuts by UBS on a lot of different regional banks. Interestingly, they increased JP Morgan, but they cut their price target for the regionals.
Ed, the banking season is just going to be another factor in the volatility story. You've got now the Israel-Hamas conflicts. That's now something that we have to plug into this volatility story. Should we, as we try and think about how the market is going to hedge some of this risk, though, should we anticipate higher volatility? Volatility has been suppressed for a very long time. It's now starting to come back. And I'm wondering what hedging strategies look like in this current environment. Can you hedge risk? Could you hedge risk in this kind of environment? Do you just buy vol? Is that the simple trade? Because stocks and bonds are moving in the same direction.
Well, there have been a lot of different, what I would say out of the money type of trading activity in futures and the bond markets. And, it's basically people looking at potentially, tail risk scenarios, like, for instance, the Fed cutting drastically in Q1 2024. So, I mean, those are the kinds of scenarios you might lose a little bit. Because you're taking a tail risk sort of not bet, but fail safe, if you will. But I think that those are the kinds of strategies that you can employ. Really, I think by and large, it's still the same tack as before, which is that the United States economy is doing well, yields will go higher, and you have to deal with that scenario going forward as well.
Yeah, Guy and I were talking about this earlier too, that just in terms of a commodity basis, the U.S. is much more insulated from any risk than, say, Europe is again. So that obviously raises a different question. Liz, as we talk vol, the MOVE index has already picked up quite significantly from September, and that caused a lot of spread through other asset classes. What do you think is going to happen? How should investors be looking at bond vol, and then how that relates to other assets right now?
Yeah, I don't think bond vol can really come down until we get through. We're looking for an inflection point, and we're not sure, right? Is the Fed done or not? We have also this unicorn, let's call it, of a yield curve steepening and a bear steepening. I mean, rates are going up all across the curve, and the curve is steepening, which is quite painful. Usually it's like, oh, the Fed's about to turn. We have, rates going down. The curve is steepening. So that's causing pain. And that's why, like we were talking earlier, Lori Logan from the Dallas Fed spoke today about term premium rising. Maybe that's doing some of their work. But those rising long-term rates, that should breed, vol and other asset classes and pain, 5% plus on a 10-year, which a lot of people are saying. That's hard to deal with. So I think, like Ed is saying, the economy is holding in, but you're starting to see people raise red flags of, could this be disruptive? The Fed doesn't like things to be disruptive. So far, we're doing okay, but vol's picking up. Long rates are kind of starting to what we call unmoor, and that can be troublesome.
Liz, do you think other central banks continue to look through energy? If energy stays up and remains expensive, say we get to $100 a barrel and we look like we're going to stay there, does the Fed look through that? Or has it learned the lesson recently the supply side shocks can have a lasting effect?
Yeah, well, clearly they learned that lesson the hard way, right? And I think, they've been pretty clear. I probably mentioned before that Chairman Powell and other Fed officials have said, listen, of course we're focused on core or super core, but where this headline inflation can bleed in is in expectations. And inflation expectations have been calm, but you see some long-run measures like the five-year forward, which is kind of a long-term one. It's creeping higher, around 2.5%. So the Fed doesn't want to see people, UI, et cetera, going to pay more for gas, kind of feeling like, oh, my goodness, inflation's going to keep going. It's not there yet, but that's where they would feel like headline could bleed into overall inflation.
Yeah. You know where it's going to get a lot harder, Guy, is over in Europe at the ECB. That's going to be a much more precarious situation, to your point. Guys, thanks a lot. We really appreciate it. Thank you for helping us unpack all of this. Liz McCormick and Edward Harrison, thank you. So coming up, we'll get more insight into the question of the day. How should investors react? Catherine Rooney-Vera, Chief Market Strategist at StoneX Financial, joins us next. And as we head to break, Federal Reserve Bank of Dallas President Lori Logan speaking at an economics conference in Dallas earlier today about monetary policy.
Higher term premiums result in higher term interest rates for the same setting of the Fed funds rate, all else equal. Thus, if term premiums rise, they could do some of the work of cooling the economy for us, leaving less need for additional monetary policy tightening to achieve the FOMC's objectives.
This was the largest operational and intelligence failure in the history of the Israeli military and Israeli government.
The complexity of this attack from Hamas's perspective was not only incredibly successful, but it was incredibly impressive.
It's a failure by the government to defend its citizens.
It can be the doomsday. You cannot know in advance what might happen, mainly because you are not dealing with rational players.
It's time really for the region and the international community to already start working on a ceasefire, already working on negotiation beyond this conflict.
It's quite clear that the Israelis underestimated their adversary.
Those were some Bloomberg TV guests reacting to the Israel-Hamas war. And that brings us to the question of the day. How should investors react? On a basic level today, it's very much sell stocks, buy the dollar, going to buy some gold, buy certain bonds like the Bund because U.S. markets are closed. That's the typical risk-off scenario. But then how do you think about it more medium term? Catherine Rooney-Vera, Chief Market Strategist at StoneX Financial, joins us now. Catherine, how should investors deal with this?
Yeah, it's an enormous tragedy. What I would tell you is that puts are still not too expensive. On our options team at StoneX, we've been looking at buying 15 Delta puts in either October, November, or December on the SPY or on triple Qs, which is the technology sector. This is something that we've had a call on for some time. It's done remarkably well. And I continue to hold that. I think that this atrocity and perhaps the ramifications that come with it involving other countries in the Middle East can increase the possibility and probability of a hard landing here in the U.S. as consumption takes a hit going into next year.
Catherine, this conflict obviously plugs into a wider matrix of events that we're trying to kind of deal with at the moment. The difficulty that investors have faced recently is that bonds and equities basically have been working in the same direction. Today, we don't get that. But in a world where bonds don't offset stocks and stocks don't offset bonds, how do you broadly, other than buying a few puts here and maybe a few calls there, how do you realistically provide diversification in a portfolio?
I wouldn't wholesale discard the 60-40 portfolio as yet, Guy. It did not work, as you say, in 2022 for sure. It hasn't worked so far this year. But what I would tell you is that I think that bear flatteners are interesting right now. I think that risk-free assets with their juicy yields, I think, are appealing at this moment, especially in the higher for longer. As you know, I've been on your show many times talking about how the Fed is unlikely to cut next year, the 100 basis points previously discounted. I think it's a good chance they don't even go 50 basis points next year. It all depends, of course, on how severe the ramifications are for the economy and if we do go into a recession or it's a soft landing approach. So I still like 60-40 portfolio. I still think that bonds should have a place in your portfolio, and I think they're getting increasingly interesting.
Catherine, we talked about volatility in the bond market has obviously picked up tremendously. Lori Logan from the Dallas Fed said that so far the bond market movement has been orderly, and it feels like what everyone's waiting for is a disorderly bond market to then get nervous about other stuff. What is going to be the catalyst for that as we look at some of these risks surrounding the market, geopolitical or otherwise?
It's hard to imagine really that there's a disorderly or falling apart of the U.S. Treasury market, given that it's the deepest, most liquid asset class in the world and the single place that China can put their trade surplus and their current account surplus So I think it's going to be hard to really see a disorderly unraveling of the Treasury market, especially when you see the US dollar remaining the sovereign reserve currency of the world. Until there's a substitute to either of those two, it's hard to imagine that even though we have enormous deficits and debt that's really getting out of whack, that we will see a disorderly unraveling there. We do see China buying fewer treasuries, so I think that could put upward pressure on yields in a structural way over the course of the coming years. But a disorderly unraveling, for me, is really hard to envision until we get a substitute to those two main risk-free asset classes.
Another way people have been trying to hedge risk is obviously by buying oil. Catherine, what are the implications of higher for longer oil prices? How would you factor that in?
Yeah, I think higher for longer oil prices are a tax on the U.S. consumer, which is already seeing higher rates across the board, from consumer loans to bank loans to credit cards to mortgages. So I do think that's going to take a toll on the consumer going into next year. I have liked the staples. I've liked oil. I continue to like those. I think the defensive sectors are where we need to be positioned going into next year, especially under this perhaps potentially stagflationary environment that could manifest.
Catherine, is it going to be energy stocks or the oil price? Because at some point, we're going to see the demand destruction potentially kick in. What do you think?
I do like, at StoneX, we are a big powerhouse in commodities, especially in energy, and we do like the ETFs that you can play in the oil space. So I would be long most of the majors with regard to major oil companies. I do think that they're going to have an additional good year going into next year, especially if we have high oil prices and ramping up of production here in the United States.
Do you buy defense stocks in this world as well? We've got one major conflict ongoing. We've now got another major conflict that looks like it's beginning. We're likely to see funding for those two conflicts, at least when it comes to Congress, being rolled into one. What does that mean for defense stocks in the United States? What does it mean for defense stocks in Europe? Should I be playing those names? They've come a long way already. Do you think they've got further to go?
I do think they've come a long way already. You could add additional defense stocks to the portfolio, but I would be careful with knee-jerk reactions, Guy. I would stay loyal and stay firm with the asset allocation that one has created going into next year, under the expectation that there's a high risk of recession, which I think has been augmented by this recent tragedy in Israel, especially as pertains to how much Iran is involved, how much other countries get involved. So I think that there is a high risk with regard to high inflation and a recession going into next year.
Okay, so treasuries are kind of almost looking interesting. You're buying some puts for the S&P, right? Gold, like, where else do you want to get defensive, whereas still take advantage of any movement that we see?
Well, I think, not to sound boring, but I think cash is very attractive. Cash, similar in instruments. So short-term treasuries, I think you can even start looking at longer duration. Like I said, the flatteners look appealing. So yes, look at treasuries, defensive stocks, gold, cash, and put options on the S&P. I would even look at put options on IWM or RUT as well. So, look for that mid-cap sort of space is what we at StoneX are recommending to our clients.
Yep. On the cash side, boring certainly seems to be working for a lot of people right now. Catherine, great to catch up. Thank you very much indeed. Catherine Rooney-Vera of StoneX Financial. How do you hedge some of these risks that certainly seem to be growing right now? The main one obviously in focus today, the Israeli-Hamas war. It is reverberating through many parts of the global economy. Silicon Valley is an area of focus. Chip stocks, huge ties. Technology, huge ties with the Israeli tech scene. We're going to talk about that connection next. The startup is coming. We'll take you to San Francisco. This is Bloomberg.
All right, it is 7:22 on the West Coast, so we do want to get to the startup. We cover the top tech stories from the Bay Area and beyond. As Silicon Valley starts its morning, now there is a very tight relationship between what happens in Silicon Valley and what happens in Israel. As VCs and startups, they have a very close connection in also terms of talent. So we want to kind of walk through that a little bit with Ed Ludlow, joins us from San Francisco. Hey, Ed, what is this relationship? How does that evolve in the middle of this conflict?
Yeah, in real terms, it's a massive footprint on the ground in Israel. If you take Intel, for example, it's Santa Clara-based company, but they have 12,000 people working in Israel. And their connection to Israel has been deepening. You know, think about the tower deal they had to walk away from last month. They hoped to buy that company, but were blocked by the Chinese regulator. They announced in June a new wafer fab that will be operational by 2027. That's kind of one way of looking at it. The other, you know, speaking to a lot of tech industry employees that live and work in Israel, is the idea of what happens next. Reservists. There are tens of thousands of people that work in the technology industry for US-based chip maker or software companies. Will they be impacted by the military strategy of what comes next in this war?
Ed, to what extent has the connection changed over the last few years? This used to be the startup nation. The number of startups in Israel have decreased. Is that because many people have made the decision to move to the United States already? How has the relation changed over the last few years?
Yeah, the data tells us that there's a drop-off of activity in the short term, right? So VC funding, the number of dollars, amount of dollars raised by Israeli startups was down 70% year on year through the first half of 2023, whereas worldwide VC funding was down sort of 49%. So it's kind of seen an outsized drop in activity. It's been home to principally cybersecurity and fintech, but also other areas like autonomous driving. Think Mobileye. Mobileye is a really interesting case study. I think the stock is down more than 6, maybe 7% in the session. Mobileye is Israel's biggest company by market cap. It is US listed, but its headquarters are in Jerusalem. And this morning, it issued me a statement saying that their operations are not impacted. What I was told by sources is that they have an investor day next month, November 14th, 15th, that had been due to take place in Jerusalem. So the data and the activity kind of contradict each other. Funding has dropped off, but on a per capita basis, Israel attracts more dollars than most countries in the world. You know, they're a smaller nation with a high draw for talent.
It's down 7.1%. So to your point, Mobileye. Yeah. So quickly, are other companies that have exposure to Israel, are they canceling events? Like, are there other evolution that's happening here?
So NVIDIA, you know, the company of the year, was due to hold its AI Summit 2023 in Tel Aviv, October 15th and 16th next week. And they've actually just outright cancelled the event, citing, you know, safety and well-being concerns for those that were due to be in attendance. There is just so much crossover. There are so many software companies that have a footprint here in the US and in Israel, and venture firms that have partners here and in Israel, and all of them are talking about what they should do operationally next.
Yep, and you're going to carry on the coverage of this. Ed Ludlow, Caroline Hyde, Bloomberg Technology coming up in just under 90 minutes' time. We're going to talk about hedging next. Vanir Bansali is going to join us. This is Bloomberg.
We're about an hour into U.S. trading session. Bloomberg's Abigail Doolittle is looking through some of the moves. Volume is a little bit light. The bond market closed for holiday. All right, Abigail, what do you see?
Well, first of all, Alex, I want to say it's hard to talk about markets amidst so much tragedy and so much horrifying activity. But the way that investors who continue to invest, no matter what is going on, the way that they may think about it, whether or not the conflict in the Middle East, whether or not it's going to affect the corporate profit outlook here in the U.S. Overall, this chart suggests that right now, investors from a macro standpoint aren't too concerned from the standpoint that the S&P 500 E-mini futures at the lows down about 1% right now, down about 0.3%. However, if we go beneath the surface and we look sector-wise, we are going to see that there are areas that are rallying and falling dramatically on the conflict between Israel and Hamas. The defense sector up 4.2% at its highs, the best day since November of 2020. Right now, its best day since October of 2022. Having a better day initially than at the start of the war in Ukraine, which says that some investors do think that maybe these defense contractors, Lockheed Martins, Raytheons of the world, that their business is going to be stronger. Energy up 3.3%, and this, of course, as oil is rallying up 3 to 4%, both WTI and Brent crude. It's unclear what the role of Iran is here, whether they will be pulled into the conflict. Luke Hickmore of Aberdeen this morning was even saying that Jordan and Russia could be, if supply becomes tight and oil rallies, rallies. That is helping out the energy complex right now. Discretionary, on the other hand, anything related to travel, the airlines, the cruise lines, they are down 1.4% on the fear that travelers, consumers are not going to want to travel amidst this conflict until more is known, this tragedy. And then airlines down 5%, the worst day since March of this year. And from the July peak down 2013, down 30% from the peak of July 13th, and really getting taken down today by both rising oil and, again, the idea that folks may not want to travel, plus some of the major airlines are cutting back, paring their air flights to Israel. As for oil, well, this is Brent crude, and you can see the big surge that we have on the day, up nearly 4%. That's 3 standard deviations higher, and after some of the recent declines, we now have WTI crude at least back above its 50-day moving average. And then finally, if we take a look, Guy, at some of the production coming out of the Middle East, Saudi Arabia clearly the most, but folks, lots of focus on Iran, and their production has been up more than 50% over the last year. Again, the question is whether or not they get pulled into the conflict. And I think that the sense is, if that happens, that this awful situation, this tragedy, this conflict could really escalate more. And that would, in a strange way or an understandable way, I suppose, help out oil as it is today and that energy complex.
Absolutely. We're watching to see what happens next. Do we see escalation? Let's get back to our question of the day. How should investors react to what we've just seen? How should they plug it in to what else is happening around the world? There are significant threats emanating from a number of different areas for financial markets right now. How do you hedge it? How should you be thinking about it? Vinir Bansali, Longtail founder and CIO, joins us now. Vinir, great to see you. How should investors react? Simple question, complicated answer, I suspect.
Well, it's not that complicated. For the first time in, I guess, many, many years, you've got short-term treasuries yielding over 5%, even long-term treasuries got to 5%. And you've got an inverted yield curve, negative carry everywhere. Foreigners are not buying our assets. You've got equities actually giving you lower dividend yield than treasuries. So I think the answer is actually quite straightforward today, is everybody should have a Treasury Direct account and be buying T-bills, not extending duration, just staying short.
Okay, but you could also make the argument that treasuries are also super volatile too. Their volatility is much more there than it is in the equity market, and you got to compensate for that. Do you feel 5%-ish is enough compensation here?
Yeah, so that's exactly what I mentioned, short-term treasuries, right? So T-bills, and I've been very careful stepping out slowly. I think now is a good time to go to maybe 2-year notes. 2-year notes have a duration of about 1.5, so they really don't have that much price volatility. Now, you could argue, what about all this fiscal issuance that's going on, and what's the risk of a U.S. default and all those kind of things? I think those are very marginal. I don't think investors should extend duration right now, but T-bills at 5.5%, 5.25%, give you insurance, give you yield, give you protection while you go into the new year. And also, we're living in a geopolitical minefield right now. As we can see, it's tragic what's going on around the world, but I don't think this is a isolated incident. I think this is going to continue happening. So for my money, at least, the short-term treasury market is the place to be.
Yeah. But if you have to own equities, how do you hedge that risk?
So that's another great and very surprising event, actually, right now, is that even though equities are high, and as I mentioned, they're negative carry, they're sort of below the 200-day moving average, which indicates a negative trend possibly developing. Hedging is actually extremely cheap. You look at equity volatility, the VIX is hovering right around 19 or 20. NASDAQ is volatility is also very, very low. Fixed income volatility, on the other hand, is very high, but equity volatility, currency volatility, extremely low. And it's relatively easy to hedge it in plain vanilla options markets, like one of your other speakers or guests was speaking about a few minutes ago.
Yeah, that was Catherine Rivera, and she said that still, like, hey, 60-40 is still okay. Like, you still need to own both. What do you make, though, of the fact that we continue to see stocks and bonds kind of move together? How long do you think that lasts for?
I think you're probably undergoing a multi-year, if not a multi-decadal trend shift that people are not quite used to it. I think the bottom on this correlation breakdown that people have been speaking about was maybe about 2 years ago when yields went negative and central banks goosed up all the financial markets. And I think they literally created the breakdown in correlation. It was inevitable was going to happen. But I think you're looking at possibly a 5 to 10 year period where correlations don't work for you like they did for the last 15 years. And I think people are going to be very surprised that they'll require self-insurance using the options markets. I'm speaking my book a little bit, but that's, I think, the reason for being a little bit more independent thinking than to just trust 60-40 or risk parity or correlation-based diversification strategies.
Veneer, what do you think? These markets feel orderly at the moment, despite what's being thrown at them. Do you think they become disorderly?
Very quickly, Guy. I think the Treasury market, as we know, has been extremely illiquid. For the first time in maybe 20 years, the Fed is selling. The other central banks who basically follow the Fed are also not buying. They're not selling, but they're probably in that period. And a lot of the emerging market central banks are not going to wait around for the Fed to finish selling. So I think the fact that the Fed is not providing liquidity results in possibly Treasuries becoming very illiquid again. That might result in a Treasury buyback, potentially. If that doesn't happen, things could get illiquid extremely quickly. And when the Treasury market becomes illiquid, everything becomes illiquid because Treasuries are basically the foundational building blocks of all financial markets. So
hey,
be
Veneer,
careful.
does that risk sort of take a soft landing then off the table? Like, does it disrupt other financial markets in a deeper way? Like, what does that do for us?
Yeah, I think what happens if you look at multi-decadal playbook again is yes, you start that process. Maybe the central banks don't say anything initially because now what they've done is effectively engineered that 5-year forward 5-year rate that I wrote about a couple of years ago. So long-term rates are coming up. Things get disorderly. They start achieving their inflation objectives because the economy now starts slowing down. Because most people make their decision based on the long-term rate. But at that point, it gives them an excuse now to pivot again. So yes, markets get disorderly. Things start kind of falling apart. But then the game is, when does the Fed and the other central banks pivot again? And they say, okay, enough already. Let's get back and defend the financial market. We're in a levered economy. You cannot function with the financial markets going through a deep hole.
Hey, Veneer, we love chatting with you. Definitely come back. Thank you so much. Veneer Bhansali, thank you, a Longtail founder and CIO. All right, coming up, the big mover in the market is oil. The attack on Israel and the war with Hamas raising worries about global oil supplies. Ed Morris, Citi Global Head of Commodities Research, joins us next. This is Bloomberg. This is Bloomberg Markets. You are looking at live shots of the principal room. Coming up, Rebecca Babin, CIBC Private Wealth Group Managing Director, will be joining Bloomberg Television at 1:30 p.m. New York time. This is Bloomberg.
The critical question of whether we're going to be able to achieve this historic peace with Saudi Arabia that pushes the whole Arab-Israeli conflict into a completely different place and can lead to a broader reconciliation between Muslims and Jews as well. The critical factor will be how Israel emerges from this fight. Or do we emerge as a victor? Because people make peace with winners. People make peace with the strong. They do not make peace with the weak.
That was Ron Dermer, Israeli Minister of Strategic Affairs and former Israeli ambassador to the U.S., speaking earlier on Bloomberg TV. Now, the role that the Saudis and Iran play going forward are obviously going to be key to the oil market. Now, the latest is Israel ordered Chevron to shut down its natural gas production at the Tamar platform in the Mediterranean Sea. We want to get more insight on all of this with Ed Morris, Citi Global Head of Commodities Research. Ed, the way we view this, the event and how it unfolds comes through the oil prism. How do you think realistically oil markets will be affected by the Hamas-Israeli war?
So it's going to be an indirect impact, and it's going to be a long-term impact in all likelihood. We have certainly the big Israel-U.S. Saudi deal, which has multiple aspects to it. Recognition is one of them. A Saudi commitment, according to the Wall Street Journal at least, to reduce the cut level of production to make prices lower for consumers. A lot of things on the nuclear side. So there is a risk that the Saudis will be not reducing their production as a result of all of this. There is a risk that there's going to be more stringent sanctions on Iran, given that even Hamas has now admitted that Iran was a motivator for the attacks. So it's unlikely that we're going to see a further loosening up of the sanctions on Iran. And I suspect the U.S. is going to make it more difficult for them to export more. we'll see the U.S. pushing, as we have with the company that you just were talking about on the gas side, working with Venezuela to increase output by a couple of 100,000 barrels a day. And I think the so-called Fragile Five will be seeing a big push to accelerate their own production. That's Iraq and Libya and Nigeria and Venezuela.
Given the fragmented nature of production now, do we need to have such a high value attached to geopolitical risk when it comes to the Middle East? Ed, what do you think that number is currently? It must be more today than it was on Friday.
Well, it is. So we've seen the jump with nothing else happening other than the events with Hamas and Israel, and the price is up by some 4.5%. Now, that's not a large jump in the world we live in. You'd expect a jump between 5 and 10%, and it's been a less than 5% jump. Even if we look back a couple of weeks, prices have gone down a lot more than they've recently gone up. So it's been a blip. It's not been the kind of response you'd expect after a big event.
To that point, though, we have seen double-digit increases in natural gas prices, particularly in Europe. And I'm wondering if the real story here is about gas and less about oil, particularly when then you overlay what's happening in Ukraine.
Well, there are a couple of things that are recent news on the gas side. Certainly is the Israelis shutting down their gas production, largely because of the vulnerability given the outbreak of conflict, coming at the same time that the LNG strikes are resuming in Australia. So there's been a kind of global impact on natural gas that we've seen in prices. But the natural gas storage situation around the world is very, very high. We're entering winter, which is expected to be mild. So I think there, too, is kind of a blip to headlines on the storage side. And we're seeing a lot of the floating inventory of LNG now going into further inventory as we get into the winter season. So I think it's a little bit premature to say that there's something significant happening on either the gas side or the oil side at the moment.
Okay. Ed, gas storage may be full, the SPR isn't. How much protection does the SPR currently provide the United States?
Well, it provides that a lot because the U.S. is, unusually large as a producer of both oil and natural gas. It is the largest producer of LNG at the moment. It is the largest exporter of combined crude oil and petroleum products. That export position has increased significantly. It's helped ease the global market. We're expecting U.S. production to grow by another 300,000 or 400,000 barrels a day before year end. We think year-on-year growth next year will be between 400 and 500,000 barrels a day. It's going to play a significant role in keeping prices lower for longer, in our judgment.
And I thought that the whole thing was like SPR. It was refilled a little bit, but we're still super low, 40% of where it's supposed to be. There's like nothing left. The administration has nothing to give. Is that just totally wrong?
Nothing left when you have over 300 million barrels, and you could export a lot of that while you're already an exporter, reducing prices. So no, I think the SPR option is still a very real one. The government may be reluctant to do so on the eve of an election year. It could come into criticism on it. We are seeing, even as oil prices are going up, gasoline and diesel are not going up as much. We've seen a collapse in diesel and gasoline cracks or refinery yields. We've seen a reduction in their prices, which means that the inventory build that has begun on the product side is likely to continue. So that's the number that the U.S. government is really looking at. It's looking at where gasoline prices are, and they look like they're going down.
Ed, do you think that the United States, with its allies, can crack down simultaneously on Russian oil exports 1 year in and enforce the sanctions more heavily, and Iranian exports and enforce sanctions more heavily? Both of them, in some ways, have been given a pass over the last few months in terms of their exports. Do you think without a significant price rise, we can see both of those two countries having a tougher trading environment?
I actually don't. I think the price cap has been more than modestly exaggerated. The price cap is absolutely not working right now. The Russians are quite happy about that. There may be less excess buying by China with Russian oil pricing at a market level. That's a different issue from what's happening in the Middle East. It's happened because of the tightening of exports by Russia, actually testing the price cap. And in testing the price cap, they've shown that the price cap is really difficult to keep imposed on Russia. So I think I would separate the two and say they had a policy of keeping Russian oil flowing. That policy, in a way, has backfired. But we've seen a big release on the diesel side, and with that release on the diesel side, which was really, the reason they cut their diesel exports was because there was so much of a better price in the international market that they were unable to build inventory. And now they built the inventory, and that diesel is coming back, and diesel cracks, diesel margins, diesel prices on a global basis are going down.
Great to catch up, Ed. Really interesting on a day like today. Thank you very much indeed for your time. Ed Moore, Citigroup Global Head of Commodity Research. Coming up, we're going to explore how big banks and traders are reacting to the Israeli-Hamas war, conflict. That's next. This is Bloomberg.
All right, time now for Wall Street Beat. We're going to take a look at how Wall Street is managing, thinking about reacting to the Israel-Hamas war. Joining us now is Bloomberg's Sonali Basak. So, Sonali, I mean, managing volatility and uncertainty is key for Wall Street. What are you hearing?
Yeah, I mean, they're the first order effects and then the second order effects. So the first order effects are, as you've been covering, the oil price moves. So you have Pierre Andouran, the famous oil trader who's been up double digits the last 3 years in a row, taking to Twitter pretty immediately, really focusing on the short-term effects versus the long-term effects. The idea here that the short-term won't be as drastic, but the long-term effects could be pretty meaningful. He said that the market will eventually have to beg for more Saudi supply, which he believes will not happen sub $110 Brent. Now, remember, these moves in particular in the market that we've seen on higher oil prices have gotten Andouran himself off the heels of poor performance this year. He has been rebounding from a very negative year to be more positive on the year. He's only down about 15% through the middle of September. Now, they're the second order effects. Earlier today, you did see the VIX start to spike, but it wasn't that much. You're not seeing that volatility seep into the market meaningfully yet. So a VIX at about an 18 handle here is above the average of 17 for this year, but below what you would have seen for the full year average, which means it's still pretty low. Remember, we're still seeing a lot of capital markets activity trying to seep into the market. Take Birkenstock's IPO, just Wednesday is supposed to trade. If it spikes much higher than 19, all of a sudden you have more normal way trading activities start to be impacted.
Sonali, normally in these kinds of scenarios, gold would play a part in people's reaction function. You'd buy gold as a safe haven. That should be a narrative that in some ways continues. Is gold now competing with cash? When you can get cash at 5%, isn't that the ultimate safe haven?
Speaking of cash at 5%, let's look at gold really quickly here in the intraday move, because you have seen gold really muted this year. It was a popular hedge fund trade coming into this year, but you did not see these massive moves in gold. Today, you are seeing a tick higher. To your point on cash here, the bond market is closed today. It's hard to know the direction of travel. I heard you talking about it earlier, the idea that Treasury futures are getting a lift. Do interest rates start to get materially higher on the wakes of this uncertainty? The second order effects that we were talking about and the whole market is talking about really is does this start to complicate the central bank hiking cycle? We've already heard from two Fed officials, despite the war, talking about how the work is starting to be done itself in the bond market. Are you still going to see a lot more pain in the bond market as we see a lot of these other inflationary pressures start to come to the surface?
Great stuff, Sonali. Thank you very much indeed. It's interesting. For the last few years, cash has not provided that safe haven. It's yielded nothing. Gold obviously yields nothing either. But maybe those two things competing with each other right now. We'll see what happens tomorrow. European bond markets are open. That's the reaction in the German 10. That's probably the most obvious comparison you can make. What's happening with the Treasuries? We're down 10 basis points. Is that a real number? Of course it's a real number. Is it a number that is enduring? We will wait and watch and see what happens there. But certainly you're seeing a classic kind of risk-off kind of day, albeit in some ways a muted one. The half-life of these stories, the impact they have on markets, becoming less and less with every cycle, it seems. The Stoxx 600 is down by 0.3%. Energy stocks are in focus. Defence stocks are in focus. That's a kind of obvious reaction. You buy the bond market, again, kind of the obvious reaction. We've seen what's happened with the dollar as well. That's the dollar versus the shekel. We've obviously seen support there as well for the shekel. We're seeing a 2.5% bid on that. All of this is kind of the obvious reaction. What comes next is what is really going to matter here. Seema Shah is going to join us next to talk about just that.